Hey everyone, and welcome to This Explainer. Look, today we're completely bypassing all that surface-level AI hype you've been seeing everywhere. Instead, we're going to dive deep into a real institutional-grade intelligence briefing on what is actually holding up our current tech economy. We're looking at the massive, historically unprecedented financial bets being placed on AI right now, and more importantly, the totally rigid walls of fiscal accountability these companies are about to slam into. So if you really want to understand the reality beneath the AI revolution, well, you are absolutely in the right place.
Now, I want you to really think about this statement for a second. This is the aggressive, kind of uncomfortable reality of the market right now. See, we're constantly fed this retail illusion of an overnight AI revolution, right? This idea that massive spending instantly equals massive profits. But the institutional reality? It's a whole different story. The world's largest tech giants have literally poured hundreds of billions into chips, which is creating immense wealth for hardware vendors, for sure. Yet for the companies actually buying those chips, their profit margins are essentially flatlining. They haven't moved. We are officially entering what we call the show me the money phase of the AI cycle.
And the sheer scale of this phase is defined by this one staggering number, $725 billion. This isn't some historical data point. This is essentially a ticking time bomb. That number is the aggregate projected capital expenditure by just the top U.S. hyperscalers for the 2026 fiscal year alone. It's a level of capital mobilization that is completely without precedent in the private sector. The stakes could literally not be higher.
Okay, so let's unpack this massive fiscal cliff. We've got 6 steps to get through today. First, the $725 billion arms race. Second, the capital intensity gap. Third, accountability phase ROI hurdles. Fourth, operational lag and bottlenecks. Fifth, the SaaS Darwinian event. And finally, number 6, the 30% valuation reset. Let's jump in. Section 1, the $725 billion arms race and the hyperspending regime. Right off the bat, we are witnessing a fundamental transition in how big tech operates. We're moving away from that golden era of self-funded, asset-light growth. Back when software companies basically just printed free cash flow, and we're entering a highly capital-intensive, debt-funded hyperspending regime. And why? It's driven entirely by the fear of obsolescence in an AI-native economy. Just look at these projected capital expenditures for 2026. That is a 61.8% year-over-year surge. Notice those highlighted figures. Amazon is projected to drop $200 billion and Microsoft $190 billion. This infrastructure sprint is so incredibly massive that it requires an estimated $1.5 trillion in total tech debt issuance over the coming years. They are shifting into heavy debt markets just to sustain this momentum.
And all this massive spending perfectly illustrates what institutional investors are calling an incestuous, or basically a circular financial ecosystem. It works kind of like this. Say a major hardware giant invests heavily in a hot new AI startup. Great, right? But then that startup turns right around and uses that exact capital to buy chips straight back from the hardware company. Or maybe a cloud provider funds an AI lab, and then that lab rents data center space from that very same provider using those exact same funds. So on paper, it completely props up this massive demand, but underneath, it raises some really serious red flags about how much true organic end-user demand actually exists outside of this closed loop. Section 2, the capital intensity gap reaching completely unthinkable levels.
So we really have to ask ourselves, what actually happens to the valuation of software companies when they suddenly start spending capital like heavy industrial manufacturers or utility companies? Well, the answer is hiding right here in these ratios. Capital intensity, which, just as a quick reminder, is the ratio of capital expenditure to total revenue, has reached historically unthinkable levels for the tech sector. Recently, Oracle reported a capital intensity of 57%, and Microsoft hit 45%. Basically, this means nearly half of every single dollar they generate is immediately being shoved right back into physical assets like data centers and servers. It's a violent departure from the asset-light dominance we saw in the 2010s. Institutional investors are watching this like hawks because fundamentally changing from cash-funded growth to debt-funded growth completely shifts the entire risk profile of these massive corporations. It ties them heavily to interest rates and credit spreads in a way we haven't seen before.
Moving on to Section 3, the accountability phase and the strict ROI hurdles waiting in Q4 2026.
Okay, the euphoria phase of just buying up GPUs at absolutely any cost, that is officially over. Management teams are now being judged purely on their ability to convert this massive infrastructure spend into reliable, recurring revenue. And the markets? They are currently pricing these hyperscalers for absolute perfection, meaning there is zero margin for execution error. Let's look at the specific hurdles institutions have set for Q4 2026. Microsoft literally must clear an $80 billion backlog of unfulfilled Azure orders, and by the way, that's a backlog currently constrained by hard limits on power and physical space. Meta, which doesn't even have direct cloud revenue, has to prove to investors that its AI-driven advertising efficiency can somehow offset a projected $24 billion in negative free cash flow by 2027. And Alphabet, they must successfully convert their rapid 40% Gemini user growth into tangible search ad margin expansion. If they miss these hurdles, the market response is going to be swift and it's going to be brutal.
Section 4. Operational lag and the physical energy bottlenecks. Now, you might be wondering, why is it so incredibly hard to just hit these financial hurdles? Well, because buying the GPUs is actually the easy part. It's operationalizing them that creates this profound technical delay. Notice this grueling 18 to 24-month gap we're looking at here. You've got up to 3 months just for procurement, then another 3 to 9 months just for data center installation and getting hooked up to the grid. Then you need another 6 to 12 months simply to pre-train your foundational models. Then you've got inference preparation. All in all, it takes up to 1.5 to 2 full years before a single enterprise software seat is actually sold, or an outcome-based pricing model generates actual SaaS revenue. And during this entire lag time, that multi-million-dollar GPU cluster isn't generating a dime of profit. It is just a massive depreciating liability sitting heavily on the balance sheet.
And honestly, even if you execute that software timeline absolutely perfectly, you still hit the ultimate physical antagonist, electricity. The physicalization of AI means that energy strictly caps actual deployment. Let's look at Northern Virginia as a prime example. Data center power demand there is projected to jump from 2.5 gigawatts today to a staggering 10 gigawatts by 2030. Think about that. You literally cannot code your way out of a power shortage. Demand for AI might be infinite, but deployment is strictly physically capped by how fast we can build real-world physical substations and route new transmission lines. These hyperscalers might actually be pouring billions into chips that they simply cannot plug in.
Section 5. The SaaS Darwinian event and the massive shift from seats to outcomes. So while the infrastructure layer is out there fighting these physical bottlenecks, there's actually a secondary cliff forming that threatens traditional software altogether. The cold, hard calculus of this is laid out right here in what we call the value stack inversion. Back in the traditional SaaS era, pre-2024, companies sold seats. The marginal cost of adding one new user was practically zero, which is what gave us those beautiful 80% profit margins everybody loved. But the AI native era of 2026 and beyond, it doesn't occupy seats, it sells outcomes and automated tasks. And actually executing an AI task carries a heavy fluctuating compute cost. This fundamental shift from seat-based economics to outcome-based economics puts those legacy 80% margins at massive risk. The intelligence layer, and basically all the value, is moving rapidly down the stack toward the underlying infrastructure providers.
And to combat this terrifying margin compression, the tech sector is rapidly adopting this brutal new philosophy. 100 people plus AI equals 1,000 people. This has officially become the Silicon Valley compute for labor mantra. And we are seeing it play out in real time with these strategic layoffs, like Meta's proactive reduction of 8,000 personnel. Understand this, that is not a sign of financial distress. Actually, it's a direct, calculated transfer of value. Management teams are systematically taking the savings from the human labor layer and injecting those dollars directly into the silicon layer, specifically to fund the very data centers driving this whole transformation.
Finally, Section 6, the 30% valuation reset and the massive repricing risk ahead.
Okay, so if capital intensity is soaring, operational lags are dragging on for years, and software margins are actively being threatened, what happens if the math just doesn't add up? Remember, institutional investors operate on math, not hype. And the mathematical modeling right now suggests that if payback isn't clearly visible by early 2027, a 30% valuation reset across the entire hyperscaler cohort is, mathematically speaking, inevitable. Here's why. As these companies take on massive debt, their cost of equity surges. Simultaneously, all that crazy capex spent between 2024 and 2026 is going to trigger a massive depreciation drag, which will absolutely crush GAAP net income starting in 2027. And finally, if enterprise adoption even just plateaus, or if that operational lag proves too deep, analysts will be forcefully downgrading terminal growth rates in their cash flow models. It's a perfect storm.
And that brings us to the primary anxiety of the institutional market. Just look at this terrifying widening gap. You've got that massive rising slate gray bar representing hundreds of billions in AI Capex spending, right next to that tiny, totally flat forest green bar representing actual AI-attributed revenue. Retail investors, they're out there buying the future potential of that massive gray bar. But institutional investors, they are staring directly at the complete lack of cash flow in that tiny green one. That delta, the gap between what is leaving the balance sheet and what is actually returning to it, that is the Capex cliff. Which leaves us with one final, very sobering question. As the tech debt mounts and that massive depreciation finally hits the books, if that tangible, cash-flowing ROI is not firmly established by 2027, who ultimately provides the exit liquidity for this $725 billion gamble? It's something you really need to think about as you evaluate the road ahead. Thank you so much for joining me for this explainer, and keep learning.